Okay.
But you tell me when to stop, because this topic
Absolutely.
we can probably
Very
talk for hours. But
So welcome to our guest lecture,
thank you.
the third in this term. As you know, next week we have another one. We have a big conference next week. But this week we are very pleased to have Doron Tay here with us as a guest speaker. He's going to talk about his background, his experience. Doron is young. He looks even younger than he is, but he's done already quite a lot of things and which are interesting. We have a few things in common, okay? He's a citoyen du monde like me, a citizen of the world. I think he was born in Belgium, he speaks a few languages, and we have something in common, a love. What is our love? Both of us have a dog, a poodle, okay? And our poodles are friends. So, hey, we are not friends, okay, but our poodles are friends, no joke aside. Okay, so...
Another great investment.
What's his name? What's his name?
Ziggy.
Ziggy. So Ziggy and Louis are friends, and we are also friends and business associates and so on. So over to you. You're going to give us your view of how you started your career at WeWork, I think, and then you're now an investor, and you studied in Israel at Reichman and in America. So we have a whole wealth of experience that we can draw on now. Over to you. Thank you.
Thank you, Jacob. So how many of you have worked for a startup? No? No show of hands. How many of you are interested in working for a startup? Okay. Show of hands. How many of you would like or have already started your own startup or your own business? Okay. I think we can all agree that startups are a crucial part of our, of our society today, but also of our economy. I think we can all agree that startups shape the future and have shaped our present. If we look now at venture capital's history and the history of startups, unlike what used to be innovation. Coming from R&D centers, within well-established corporations, today most of the innovation comes from, venture builders and startups. So I'll start by sharing a bit about my story. Although Jacob, first Jacob already shared a few of the details on my background. I actually have quite the untraditional career path, and I think it's great to share that side of my journey, especially for students who are still working out, and I consider myself still a student. I'm still learning as I go, and so I think seeing that there isn't one correct or one right way to find your career path or your journey when it comes to what will probably be part of most of your life. I think it's a great one to share. So I actually started my career in equities, working as an analyst at Bloomberg, and very quickly noticed after crunching hundreds of statements and restructuring statements, computing data for investment decision makers, that I desired something that I couldn't find where I was, and that was meaning and purpose. And I thought, well, I studied finance, business with a major in finance. How could I, where could I find meaning in finance? And so what I thought, at first I thought, okay, relationships are definitely an important and crucial part. But the more I thought about it, and startups started to make a lot of sense to me, particularly like the venture world. And right about that time, so I've around 2016 met one of the early investors of WeWork, who introduced me to Eugen, who came from Airbnb and was just hired by Adam Newman to start his expansion into Europe. So they were just setting up their first offices in the UK, and were planning to expand in pretty much every country possible, and to change the corporate real estate model as people knew it completely, from old and dusty offices to a new model which allows people to feel excited to come to work, and where they can collaborate with others, meet like-minded entrepreneurs, and at the same time also have more advantages in terms of the lease terms. And I didn't know much about the startup world. I was probably very much like most people here in this classroom at the minute, clueless about it. Yes, of course, I've read a ton about it, and saw plenty of valuations on the news, saw plenty of founders talking about their brilliant ideas, but really didn't have much exposure. But as soon as I met with Eugen, who came from Airbnb, and basically what he did at Airbnb is, being the missionary of Airbnb, he pretty much exploded and spread the word about Airbnb, and got Airbnb to become a leader in the hospitality space in Europe. Listening to his story with Airbnb, and then listening to what he was planning to do with WeWork, I was sold in that very moment, and I just had to hope that they would see something in me to be able to join their team, and be part of that hyper growth team that was going to expand into every single major city in Europe. And luckily enough, I got to participate and be part of that journey, and a little later started to expand into every possible city, at first working with entrepreneurs mostly, and slowly then also expanding to more established enterprise and corporates real estate requirements. By 2019, we reached about 3 billion in sales globally, and the region of specifically the UK, but EMEA in general, was one of the most profitable and most successful regions in the portfolio. By 2019, I personally reached a stage where I had fulfilled the mission that I came forward to begin with at WeWork, which was to create spaces that are inspiring, and where entrepreneurs can feel like they can come and have an office space without having to take significant risk in terms of like lease terms, and where they can go and collaborate with other like-minded entrepreneurs. And we've done a lot more than that. Obviously, we've completely changed the real estate model, and today people think in a completely different way to what they used to. So at that point, I started thinking, well, what's next for me? I was very comfortable. Financially speaking, I was well compensated, but I started to have sleepless nights. I couldn't really rest, and I thought, well, this is really strange. I'm very comfortable where I am. We've done phenomenally well, but something is clearly bothering me. And I quickly realized it's that when you stop challenging yourself and you start being too comfortable, your body will and your mind will start to speak to you and tell you to do something, whether you're challenging yourself within the corporation that you're in, or whether that's something outside of it. And so around that time, I've kind of reflected and took some time to think about where I would like to add value next. And one of the things that struck me most during my time at WeWork was not particularly the executives I met of FTSE 100 and S&P 500 companies that shared about their real estate challenges. Of course, those were equally important conversations, but those that I found most inspiring were the ones that I had with the entrepreneurs that came with a small team of 2 or 3 people with an idea, and seeing them grow into industry disruptors, or innovators of new industries altogether, and seeing them growing and really shaping future for the better. Those are the ones that really inspired me, and that's when I realized I really want to be on the financing side of these people, and at the same time, obviously I wanted to be there as a handing help with my operational experience, throughout my time at WeWork, having learned many do's and don'ts of scaling a startup, and particularly in hyper growth environment. So I thought, well, okay, how do we go from here to becoming, to financing venture companies, and especially considering there are so many venture funds today, and I thought, well, okay, let's look at let's look at the venture model, and let's look at where there might be gaps that need to be filled or where it might be broken. One area that I quickly recognized that was probably broken was the high net worth and family office world. So think of people who have very traditional businesses and look to reinvest some of their wealth. Usually, a lot of that will probably be into equities or into their existing businesses. Obviously, fixed income will also be a significant part of it, but more and more high net worth investors and family offices are investing in entrepreneurs and occasionally also in venture funds. But what really I found fascinating was that people invested into entrepreneurs that they met by complete chance. They just liked what they were presented and they liked the idea and thought, okay, why not go and back this entrepreneur? I believe he's got what it takes to execute and deliver on the business plan that he's presenting, and why not take that chance? So well, that's really interesting. We've got an investor that wants to have, or an individual that wants to have exposure to backing entrepreneurs and venture financing, but who does so in a completely passive way. And I thought, well, why do they do that? I quickly recognized that they want to be involved, they want to be part of the process, but at the same time they don't really have the time. So most of the time what ends up happening is that they are making this passive investment into the startup, into the entrepreneur, and just hope for the best. Whereas really they could add so much value and leverage all of their skills, network, experience, and knowledge, which would be a huge help to the entrepreneur. So having thought about that, recognized we could probably address that market. So we went and spoke to a couple of founders. I say I around that time met my partner, who was an investment banker at Regent. He was doing M&As and IPOs, so helping companies essentially go public or exit through a merger, and both shopping for buyers and sellers. And we shared very similar outlooks. He had the experience on the exit front, which is obviously crucial, and I had the operational and growth experience, which is crucial in the in the early stages of any venture. So we made a good team, and we saw eye to eye and decided to team up. We both had pretty good, I mean, it's very small, but decent network to start off with, and all you need is to start somewhere. So we presented the idea to a couple of family officers, and it was an extremely challenging time, obviously. By the time we started, we were looking at 2020, beginning of the pandemic. We just closed our fund and finalized a legal structure, which is a very lengthy process, which I won't talk about too much because you'll probably find that boring at this stage. But we managed to get the interest of a few family offices and got started. We as fund partners obviously had a stake, and had to have skin in the game. So we also put up some of our personal funds in. I maybe forgot to mention, but in 2019, I got an opportunity to exit through a tender offer to SoftBank at a 47 billion valuation, and that was just before the first IPO attempt. I did not know that the IPO wasn't going to go down well. I didn't have much experience with roadshows or anything of that sort at the time, but I knew what was going on in the organization, and personally, more importantly, I knew I was planning to make my next move. So we started this fund in 2020, and fast forward today, we've invested in a number of sectors. So we've invested mostly in early stage, so pre-seed to Series A. AI, artificial intelligence, has been a big part of our focus, which is interesting because we started in 2020, and there wasn't as much. I mean, ChatGPT was very much in the making. There wasn't too much noise about artificial intelligence. I mean, everybody knew that artificial intelligence is going to be the fourth industrial revolution, but and there was a lot of talk about it, academically speaking. But in the venture world, no one knew exactly how it was going to take shape, and that's the part also about venture is you don't really know what the future is going to look like, and unlike R&D centers who like to bet on what the future is going to look like, venture understands that you shape the future, and the entrepreneurs that will succeed in delivering on their business ideas and business plans are the ones who are going to shape it. So that's my story in a nutshell. But we invested in a wide variety of industries and sectors. Gaming having been one of the strongest industries, as you can imagine. During the pandemic, a lot of people spent a lot of time at home, and had the budget as well, because there was a lot of stimulation through quantitative easing and different fiscal stimuli. So people had the budget to spend time on gaming and all sorts of other things which allowed the economy to continue and to grow. That's really it. I'll tell you a bit about the venture the venture building and venture investing economy, and what I perceive as some of the pillars or some of the interesting aspects of venture investor and venture venture investing, and then also venture building, specifically with I think the number one place to start really is looking at networks. If you look at any success story, you'll probably find that network played a huge part behind that success story. So if you think about Airbnb, for instance, right? Brian Chesky was going to give up on his startup until the very last minute, when he pretty much had already given up because they were running out of funding and nobody would back them. And he then last minute got told to apply to Y Combinator, and through connection of his managed. I mean, you all know probably the story of Airbnb. So that's just one example, but there are so many examples of I think WeWork, for instance, is another great story, where Adam also tried knocking at so many doors and had to go through so many introductions until he finally reached the one landlord that agreed to work with him, and gave him the opportunity to essentially test out his idea, and where everything started. So for venture builders, for startup innovators, founders, it's an extremely crucial part to focus on. And I think the sooner you realize that you can't do anything just on your own, and the sooner you put your pride away, the quicker you'll be able to accelerate as a founder. And then obviously on the venture investing side, investors very much rely on having a good amount of deal flow, and not just any deal flow, but the best of the best. What you want to be obviously investing in the best founders with the best ideas, with the most promising opportunities in terms of like market size. So network again plays a crucial part in being able to develop that deal flow, and to be able to source those deals with those with those investors. So where do you start, right? I mean, the answer is there is no one way, but if you just start somewhere. So if you start looking at your network, if you look at the tools that are available to you, if you feel like I don't have a network, if you think of like LinkedIn or any of the other media channels where you can probably reach people, or when people can reach you, just literally anywhere, wherever you start, you'll be surprised if you just keep on going how far that will take you. I mean, you're just a few degrees away from connections that you could never have imagined right now to be able to get. So the key part again is to always tap into your network and try to network as much as possible with the smartest and most brilliant minds, and both with operators, founders, and investors, because they tend to attract each other really. And so the closer you're getting to those people, and the more you will be able to attract them as well. And then you might ask, well, how do I do that? And why would they be interested in me? What do I have to offer? Why would they be interested in speaking with someone like me? And that's a brilliant question, and it's a really good one to ask yourself as well. Is to ask, well, how, why would they want to speak to me? And the best way to frame it is like, think about, where do I personally, on a personal level, add value, and how can I add value to the person I want to meet? And sometimes sometimes it's obvious, the answer is obvious, and sometimes you might want to ask the person, or the person that you think could introduce you to that person, and that's a great way, obviously, to build connections, build relationships, because it's all a matter of like adding value to each other. If you add value to someone, they'll be more inclined to add value to you, and that's really what the venture community is about. It's about adding value to each other's networks, portfolios, the companies and founders, and that can be commercially, operationally, capital-wise. It can be there's so many different ways in which you can add value. And so that's network. I think that another aspect which is very interesting, especially considering you're studying venture capital, and this is part of a finance course, and entrepreneurship. One interesting thing that we discussed earlier was how do you do finance without finance, right? I mean, you're talking about young companies that have they don't have predictable cash flows. There's no you can't really apply the PE ratio, or how can you look at book value? I mean, there aren't real assets just yet. So how do you really do risk management in such a situation? How do you evaluate risk, and how do you mitigate, most importantly, risk, right? The number one, obviously, aspect of risk management is risk mitigation, and obviously you want to create the biggest risk reward spread. So there are a few things which are key to risk mitigation, but I'd love to hear maybe if anybody here has potential thoughts on how you can do risk management in such situations, and how you can mitigate risks. Anybody? Don't be shy. All right, fine.
An assumption.
Sorry?
Try to make assumption.
Trying to make assumptions. So you're saying like removing assumptions?
And
And
try to make it, to build it for the future. Like
okay, so like forecasting.
forecasting, making
Okay,
milestones.
making creating milestones. I mean, that's a good point, and creating milestones are actually a very important part of venture investing. But obviously, creating forecasts and building milestones, you still have no guarantee that those milestones will be achieved. But definitely milestones are great, a great aspect, and I'll talk more about milestones and how they can help you in risk mitigation. Any other ideas?
I think essentially it boils down to your market research and your market analysis, and just conducting the adequate research you need to for whatever it is you want to carry out. I think that's essential.
Yeah, absolutely. Market research, again, super important and crucial part, especially before you are going into conversations with investors. If you think about it, you've got one chance, and if if you don't know your market in and out, you're in big trouble as a founder, as you clearly understand. Any other ideas?
To set a financial plan and business plan, kind of assumption, but like how you really go to come up with your business, and if you can make it profitable and in which time.
Okay, so yeah, business planning and presenting what you're saying is basically execution, how you're going to execute on your business plan. Yeah, great. Any other ideas?
Know the market, or also know your competitors.
Okay, yeah, competitive landscape, absolutely. Definitely, I mean, in some cases you've got a competitive landscape if you're entering an existing industry. In other cases you're talking to someone who's innovating and creating something entirely, completely new industry. But absolutely, you've got to know your competitive landscape. Anyone else want to share something?
Maybe by trying to keep the cost as low as possible and trying to create revenue as soon as possible.
So to create, yeah, I mean, obviously, revenue generation is super crucial part as well. But it doesn't. The interesting thing is that all those points are super important, points that all take part in the process of venture building, and specifically also in venture investing. And investors and founders talk two languages essentially, right? Because if you think about venture builders, they're talking about they're obviously very passionate about their product. They talk about the opportunity, the potential, and about hopefully they are talking about how they're going to deliver, how they're going to execute, and hopefully they can maybe even show some revenues, to show some traction, so that you can actually. So this isn't just an idea. I've got a proof of not even a proof of concept. I've actually got a business with a good product, with a clear product market fit, and you can go and talk to customers, and that will allow you to, as an investor, then obviously, do more diligence and hopefully also, mitigate risks. But ultimately, you're still left with a great amount of unknowns. Because and from the investor perspective, he talks a different language. He's looking at, he's talking in terms of risk. How much of a bet, how much risk am I taking here? And as an investor, I don't want to be taking any risk at all. I want to invest when I feel this, there is the chances and the statistics are extremely favorable. And how can I create that? In some situations, you will have founders, obviously, who have already been there, done it before, and the experience of having built a venture before, having gone through all the pain and effort and the mistakes and the learnings of building a venture are skills which are priceless. And if you look statistically at founders who have successfully built ventures before, even the ones who haven't, they're likely to eventually and either to eventually or again successfully create their the next business or the next startup. So one of the things that venture investors and venture builders can do to mitigate risks, and at the end of the day, venture builders want to understand how they can mitigate, if they are smart, they want to understand how they can mitigate risks so that they won't, so that the investor won't be able to find any gaps in their business plan. And so if you can start thinking about like, okay, what areas can be perceived as risk, think about gaps in skill gaps on your founding team. Think about risks associated with for instance product market fit. Think about risk associated with let's say the barriers of entry. There might be low barriers of entry or perceived low barriers of entry. Or another risk could be this is the idea is so great and so big in potential, but we're talking about something which is extremely technical. Think for example of Genentech, who had successfully created what we would consider lab-produced insulin. Up until then, they basically withdrew insulin from cows and pigs. They were the first to invent that. In this scenario, you were talking about something that nobody would have believed possible, and people started to believe it was possible. But even if it were, it would take decades until you can make that happen. And guess what? Venture allowed venture financing and venture capital and venture investors have allowed that to happen. And but obviously you're still looking at something which is perceived as extremely high risk. So how do you mitigate risks in such scenarios? And there are a number of ways that you can mitigate those risks. And one of them obviously being if you don't have a proof of concept yet, obviously get your proof of concept as soon as possible. Start getting revenue, start getting traction, start getting users. Those are the most crucial parts that you'll want to see, not just for the investors, but also for you as a founder yourself. Because the sooner you start getting data and feedback, the quicker you'll actually be able to build a product which your market actually wants. Because oftentimes what you think your market wants is not necessarily what your market needs or actually desires. So that's obviously one thing that you can do. In other cases, there might be already a company that's doing or a startup that's doing well. It's got already some traction. It's got revenues. It's got a customer base. It's still very young. There's still like a high amount of burn, and they're not profitable yet. But you can see the potential as a venture investor, and sometimes that means actually listening to the venture investor and seeing what they perceive as the market opportunity, because sometimes what you're seeing isn't the full picture. One investor that's been phenomenal at doing that is Don Valentine from Sequoia. He's done phenomenally well in that way, if you go and identify the opportunities and you agree to collaborate and work with your venture investors who probably have who are probably well suited to expand and bring your business to its next level, you can potentially create a situation where you've got a business which isn't yet venture investable or venture backable, but thanks to the open-mindedness and the creativity of both venture investors and venture builders, you have a situation all of a sudden where one product all of a sudden turns into a whole suite of products, and that obviously exponentially grows the market, and that's the number one thing that you will be looking for as a venture investor. is the size of the market. If the opportunity isn't isn't worth billions in size, and not because venture investors are vain, but just because they're realistic about the outcome. We're talking about startup ideas and startup funders with high risk opportunities. So you're gonna have to have opportunities which can pay out for the majority of your portfolio, and that's the other part where risk mitigation comes. So like right now, what we spoke about was active investment, right? So active investment means getting involved, making a plan, building milestones. Sometimes you can say, look, let's get you this and this in place. Let's bring you this person on the team, and let's expand and build X, Y, Z processes and products, and say then we've got a backable business, and I believe in you as a founder, and I believe in the opportunity if those components are there. So let's get you there, and those are milestones that we can create. I can bring my network, and I can bring my my knowledge and experience to bring your business to that stage. So that's that's what we would consider active investing. But one of the probably well-known components also of risk mitigation today within the venture world is the power law. Have any of you heard about the power law? Okay, so under the power law, essentially 1% of your investment will will basically account for 99% of your returns. And what does that actually mean? It means that you basically have a few investments within the portfolio who are going to generate the majority of the returns, which is extremely impressive, but also unusual, unlike other statistics. But what's so impressive, obviously, is that those returns account for the majority of your portfolio, and that's of course because those are high risk opportunities with which if they play out well will compensate in ways that no other investment opportunity or asset will be able to do. And so if you think about the power law, under the power law you must be able to diversify, and by diversification I don't necessarily mean to invest in as many startups as possible, because after a while diversification loses its value as well. But different venture investors will agree on different a different pool of and number of investments that one should have in a venture portfolio. Some will probably say 25, some will say around 35, but either way, the important part is to have a pool and a portfolio of venture companies who all tick the boxes of opportunities that could generate 100 or 1,000x in terms of multiple and invested capital. And so that's one of the key components to building a strong venture portfolio. I think that's probably the most important part, because if you're investing in the wrong companies with the wrong opportunity sizes, and you don't apply if you don't consider the power law in your venture investing portfolio, then you might be in trouble if the ones that do present the venture opportunity don't play out as you would predict them to. So that's that's another part. And if I can recommend any books, we just spoke about the Power Law. So the Power Law is a fantastic book on venture capital and venture investing by Sebastian Mallaby. I highly recommend the book, and I think maybe now we could. I mean, there's obviously a lot more that we could probably talk about and that I could share, but I think that's probably a lot for for one session, and I think maybe we can go into questions, and maybe you have some some ideas that you'd like to share or question or ask about.
So thank you so much. So any questions that you have so far?
Yes.
Yeah, Dean.
I'm curious about your experience in WeWork. If you can tell us a bit about how it works with operations and how was it for you?
Yeah, of course. So it was very interesting. So when I came there, there was no real structure yet in place. We had to build our own structure. So we started off with a very small team. So we had to wear many hats, something which is very typical for young startups, and we had to start somewhere. So we have to wear those different hats, starting by doing the business development, at the same time also acting as account executives, account managers. So you basically doing everything from an expansion perspective to spreading the word, marketing, identifying potential new opportunities for expansion, and of course the most important and crucial part, which is when you're coming and trying to disrupt a market, especially when it's in a very unusual way. There's some level of education, of course. You're talking, in the case of we were talking about office space, about corporate real estate. So it's not something which is new as a category, but the way in which the model was completely innovative and something that no one really knew was possible or even knew what it would mean or look like. So there was a fair amount of education as well, and so a fair amount of what we did was going out and spreading the words and explaining the model to people. But of course, there's only so much that words and education can do, because people are not that interested in hearing about new products, and but one thing that people are interested in is experiencing new things, because that allows them to quickly understand and quickly make up their mind. And if you have a good product, you'll feel very comfortable about getting people to experience your product. So one thing that we did was getting people to come in for a coffee, which is a very low customer acquisition cost. If you consider the cost of that they'll be probably spending on an office space. So that's one thing that we did in a minute. Obviously, people come and experience something that is much better than anything out there in the market. It won't take long for them to be convinced. And actually, on the investing side, Adam took a very similar approach, and so did his team. The key has always been in getting people to experience the product. So people, investors would come into the office and experience and see, maybe not always from the get-go, from the first conversation, but it's usually what would seal the deal for investors and Adam. So does that answer your question?
Yes, definitely. I'm just curious if was it your team that recognized the real estate options in the different cities that you came in, or?
So we had a few teams. At first, Eugen did a great amount of work to begin with. My involvement was more on the growth and expansion side. So building pipelines, qualifying leads, getting people to come and see the spaces and then closing the deals, closing contracts with the customers and with the members. So the real estate side, we had a team that was hired, and they would identify and work with landlords. That wasn't a separate part. I got to work a little bit with that team as well, but that's a completely different challenge, because you have to go and convince the landlords to change and to work with what was considered a very unusual tenant who wanted to do something very unusual with your building and your asset. So how do you get them to agree to do that? So obviously you can try to get them to see the future as much as you like, but at the end of the day, there are, from a landlord's perspective, you're looking at the grade of the tenant, and if they don't have much of a history and they're a startup, that history is going to be non-existent. So you're going to have a very tough time. So obviously they had to pay a premium, especially in the beginning, at times, but that premium obviously is something that was considered in the cost of growing the business, and also was still permissible because of the business model of WeWork, the way that the offices were split, and the way that the margins were. It allowed to pay a premium, because obviously if you look at from a square footage perspective, yes, members were paying and tenants were paying more per square footage in a WeWork. But what obviously WeWork realizes that it doesn't matter how much space you have. At the end of the day, you're coming into to work and collaborate with people, because as we know very well today, you can work remotely and be at home. So the reason you come is to be together with other people, and that's where shared space is super important. And if you've got a fair amount of shared space, and you've got a private space where you can work and be on your own, or just with your team, it will only it won't pose an issue. It will only actually create more opportunity for the members, for the tenants, which it didn't have before, when they were in a moldy carpeted office space on their own, essentially, with no other business owners or founders or companies, or and especially also if you think about the evolution that WeWork went into, as it brought more and more corporate and enterprise level customers. Obviously, those created opportunities also for the startups and for the startup founders, because all of a sudden the company that they've been targeting in their pipeline, and the lead that they've been trying to get to, all of a sudden happens to be in their building or in one of the other WeWork buildings, and they could easily reach them, or agree to at least have a coffee, because you're all part of this community. And also it's kind of taking down the barriers between corporates and startups, because there's so much that startups can learn from corporates, from enterprise level firms who are more established and who have more structure, especially for the future, as they want to gear up towards becoming a public company potentially, or towards a merger. But and then equally start, there's so much that corporates and enterprise companies can actually learn from startups. So one thing that you'll notice is, as you start growing a startup, is that you need to institutionalize, and you need to create more structure, and you start losing that startup magic as you grow. And so if you do stay in touch with those, with other startups and with other startup founders, you can always remember how to bring that spirit in the business while retaining that structure and yeah, I'd say that's the key.
Thank you.
A question.
Yeah.
I see that you are very involved in this sector, and I would like to ask if you can give us some tips about creating new startups. So, what are the fundamental tips? And some foundation.
If I understand correctly, you're saying, where do I start?
Yeah,
Yeah?
a bit generic, but like from the idea maybe.
From the idea stage.
Yeah.
Okay. I think that your questions here actually mentioned market research and earlier. I think that's obviously a crucial part. So I think first understand the competitive landscape. If it's an existing industry, you want to understand the landscape and how competitive it is. Who are you going against essentially, and that's because it will help you to understand what you're going against. Will help you to understand how much resources you will need to to be able to break in and break through that market. The other part is obviously to understand is this a viable business idea? So how much is it going to cost me to build my product or my service, and how much am I going to be able to sell it for realistically? And if the margins are sustainable, then and there aren't too many great barriers of entry, then you probably have something that might be worthwhile pursuing. If you're looking at some if your idea or your business product, your service doesn't have margins that are sustainable, or as we can see today, especially in this market, if you don't have that, and you're gonna really struggle to scale that business unless there's a great amount of quantitative easing, and there's essentially what I would call free money in the market. You might be able to build something and expand if you have the right crazy backer. But I would say those are probably the maybe two things. I mean, there's obviously a lot more that you can do, but it's a good place to start. And if it's if you have I think the third part is to understand can I build this myself? I think, and if yes, great. If no, who do I what do I need? Who do I need? And how much is it going to cost me? Or can I the best scenario obviously is, can I go and bring someone that can fill in those skills, those gaps? If you can bring someone, that would be obviously ideal. If you have to spend money to bring someone at the beginning to fill in those gaps, the question is that how much do I have to spend, and is it a risk I'm ready to take just to get started? But the most important part is if you've got the business is sustainable, just to get started and build something. You won't have always all of the answers from the get-go, but if you start, at least you will start getting literally live feedback, and that's the most valuable thing that you can have as an entrepreneur.
Yeah, but like there are a lot of startups that reach the status unicorn, and do you think that is only the idea that can carry everything, or like you need to also build a foundation?
Sorry, can you repeat your question?
Build a foundation. I mean, you need to provide also future foresight, also, or like you need to provide like material proofs. I mean, because there are a lot of
Are you saying like do you need a proof of concept or
Yeah,
product
exactly.
market fit. Yes, absolutely. I mean, look, if you're Elon Musk, you don't need anything. You just go with your business idea, right? And you're gonna have, you know, 1,000 investors knocking on your door and ready to invest in your business idea. If you've got no history behind your track record as an entrepreneur, of course you're gonna, you know, product market fit and, you know, and proof for that is going to be crucial as well. So if you can find the least expensive way to launch your product or your service and get what venture investors would consider product market fit, then you will be in a really good place to raise venture capital.
But also a lot of like unknown founders reach the status unicorn just, do you think so, also for luck, or also a bit of skills, you know?
What do you mean?
Like I think that for reaching an high investment like this, like 1 million, I think you need to be also lucky, right? What do you think? Knowing the right people?
No, you need to create your luck. Yeah, you need to create your luck. You need to create your luck, absolutely. You need to, and you know, you're ultimately, at the early stages, you're the person that they're going to back. Everything else is there just to, again, it's part of the risk mitigation process, and because as investors you want to mitigate risk as much as possible, but ultimately when it comes to the decision making of investors, you're the person that they're going to back, and so if you demonstrate that you can mitigate all those risks for them, and you're putting yourself out there, you're reaching the right people, the right investors. You have to be able to demonstrate those things. So you're the person that they're backing, and that's why early stage investors are extremely people centric.
I think last question perhaps. I think
We had a question there.
You have a question?
Yeah.
Forgot.
Yes, it was a follow-up in regards to his question about WeWork and your time there. I just want to understand whether there were any acquisitions or it was all based on the model of like rental arbitrage, where WeWork is not actually acquiring any properties, and it's I just wanted some clarity in terms of that.
Yeah, of course. It's a really good question, actually. So the way they started is through a lease model. So they did not acquire the assets. So they were lease and then sublease, essentially. So that's the model that they started off with. Eventually, they started to, obviously, I mean, it's always been obvious that there's a lot of value in the assets themselves. But obviously, we're talking about Class A real estate. How do you get your, first of all, you don't have any, track record. It's going to be extremely challenging to get banks to give you financing. But let alone finding the right assets to acquire and getting and also getting landlords to agree, etc. It's quite complex. But yes, eventually WeWork did go into an acquisition model as well, or part acquisition, sometimes in joint venture with other landlords, other times on its own, but it formed a part of the model further down the line. And I think it's the reason I think it's a really good question is because I think everybody probably has heard maybe about the or at least part of the story behind WeWork. Everyone knows that it struggled during its first IPO attempt. Of course, there were a few concerns around governance, but there were the market was already starting to change at that time. The macro environment started changing. All of a sudden, a startup which was extremely extremely hot, extremely in demand by investors, extremely backable, started to face certain challenges because there started to become a very expensive business to back, because we're talking about a hard asset which is extremely expensive to grow and expand, and it's why it needed so much capital. And who knows where WeWork would have been would it not be for Masayoshi Son and SoftBank backing and saying, go and build and do your thing and fulfill your mission. I think we were in an exceptional period of time that allowed and facilitated that. But needless to say, you look at so many people and so many businesses that replicated that model, traditional companies, and look at Regent, for instance, which was the biggest competitor in that landscape prior to WeWork coming in. I mean, they've had to completely rethink their product, and there's a lot of people who successfully created smaller versions of that product, and we've done so successfully. But when you scale something at that growth rate, it's going to be extremely challenging when you're dealing with a hard asset versus a software which doesn't cost you anything to scale, because you're just essentially just distributing more licenses to more users and more companies. So that's why people are very fond of soft products and software, because it doesn't cost much to grow and expand compared to a hard asset, which and especially with something like real estate, which is probably one of the most expensive hard assets in the world. So that's why it faced some of its challenges, and it had to obviously go into a period of restructuring. I think everybody recognized it would have to go into some period of restructuring, because after growing for so long, eventually you need to start focusing on profits as you go into the public markets, and focus on achieving and distributing some of your earnings. But obviously WeWork at the time was in a different place, the market was in a different place, and they thought they'd be able to do that after going public, whereas really they had to start getting close to that until they could actually go public, because of the way the market evolved and the way the market reacted to their roadshow and to their entrance, essentially, or their attempt to enter the public markets.
Okay, thank you so much, Doron. It was a real pleasure learning from you about networking. It's very key to us here at Regent University, networking, about risk management, about your insight into WeWork. I think it was very interesting, and in general the kind of advice that you've given us, and I think perhaps a round of applause, and thank you so much. I think the recording is going to be available. And
you can reach me, by the way, on LinkedIn if you've